Trillions simply vanished in thin air, a horrifying financial implosion. The 2008 financial crisis was a maelstrom of unseen pressures and deceptive dealings that shattered global markets. The bedrock of our financial system felt like shifting sand, a crisis fueled by complex instruments and profound conflicts of interest. Major credit rating agencies, supposedly independent guardians of financial safety, found themselves entangled in monetary incentive webs. They were paid handsomely by the very institutions issuing the complex mortgage-backed securities and collateralized debt obligations they were tasked to rate. This created an undeniable downgrade dilemma. Their business model hinged on assigning AAA ratings to incredibly risky assets, often worth millions. Many believe these agencies were complicit in a systemic failure, giving a stamp of approval to what were essentially ticking time bombs. Unseen pressures mounted as the housing market swelled to unprecedented heights, driven by subprime mortgages offered to millions of borrowers with questionable credit histories. These loans represented over 10% of all mortgages. Banks lent billions without proper due diligence, often securitizing these risky loans and selling them off to unsuspecting investors worldwide. When the housing bubble inevitably burst, the dominoes began to fall at an alarming rate. Suddenly, millions of these mortgages went bad almost overnight. More than 100,000 homes faced foreclosure each month at its peak. The market for these securities evaporated, causing a liquidity freeze across financial markets. Firms that had invested heavily in these toxic assets faced catastrophic losses, numbering in the hundreds of billions of dollars. Lehman Brothers, established for 158 years, collapsed in spectacular fashion, sending shockwaves throughout the global economy. This was a true systemic shock that threatened to bring down dozens of other financial giants. Government bailouts totaling hundreds of billions became necessary to prevent an even deeper collapse, an unprecedented intervention. Millions of jobs were lost globally. Estimates suggest more than 8 million employment positions disappeared in the United States alone. The global economy faced its worst downturn since the Great Depression, almost 80 years before. Trust in financial institutions plummeted to an all-time low. The entire episode exposed glaring regulatory deficiencies and a culture of excessive risk-taking within the financial sector. It highlighted how a few secret deals and conflicting interests could unravel years of economic stability for billions of people, impacting everything from retirement savings to daily livelihoods. The repercussions of these actions continue to be felt for many years afterward. The very watchdogs of finance were paid millions to deceive. The 2008 financial crisis erupted as a maelstrom of unseen pressures and deceptive dealings, shattering global markets and trust itself. This epic downgrade dilemma exposed how major credit rating agencies, supposedly independent guardians of financial safety, found themselves deeply entangled in vast monetary incentive webs. They received handsome payments, often millions, from the very institutions issuing complex mortgage-backed securities and collateralized debt obligations they were tasked to rate. Their business model shamefully hinged on assigning pristine AAA ratings to incredibly risky assets, sometimes worth hundreds of millions of dollars. Many believe these agencies were complicit in a systemic failure, essentially giving a stamp of approval to what were ticking time bombs destined to explode. Unseen pressures had quietly mounted as the housing market swelled to unprecedented heights, driven by a tidal wave of subprime mortgages offered to millions of borrowers with questionable credit histories. These risky loans shockingly represented over 10% of all mortgages issued nationwide. Banks lent many billions without proper due diligence, often securitizing these dangerous loans and selling them off worldwide to unsuspecting investors. When the housing bubble inevitably burst with devastating force, the dominoes began to fall at an alarming and rapid rate. Suddenly, millions of these flawed mortgages went bad almost overnight. More than 100,000 homes faced foreclosure each single month at its terrible peak. The market for these once highly rated securities evaporated, causing a catastrophic liquidity freeze across global financial markets. Firms that had invested heavily in these toxic assets faced catastrophic losses numbering in the hundreds of billions of dollars, a staggering sum. Lehman Brothers, an institution established for 158 years, collapsed in spectacular fashion, sending profound shockwaves throughout the entire global economy. This was a true systemic shock that threatened to bring down dozens of other financial giants, threatening total collapse. government bailouts totaling many hundreds of billions of dollars became absolutely necessary to prevent an even deeper collapse, an unprecedented market intervention. Millions of jobs were lost globally, with estimates suggesting more than 8 million employment positions disappeared in the United States alone quickly. The global economy faced its worst downturn since the Great Depression, almost 80 years before causing widespread hardship for many. Trust in financial institutions plummeted to an all-time low, reflecting a deep-seated betrayal. The entire episode exposed glaring regulatory deficiencies and a pervasive culture of excessive risk-taking within the financial sector. It starkly highlighted how a few secret deals and profound conflicting interests could unravel years of economic stability for billions of people, impacting everything from their retirement savings to their daily livelihoods. The dark repercussions of these actions continued to be felt years afterwards, shaping policy and public perception for an entire generation. Over $3 trillion of household wealth just evaporated. The 2008 financial crisis unleashed an unprecedented economic earthquake, globally impacting billions of lives for years. Around 8 million jobs disappeared in the United States alone, pushing the unemployment rate past 10% by late 2009. Housing prices plummeted by more than 30% nationally, leaving millions of families underwater on their mortgages. Over 5 million homes faced foreclosure proceedings between 2007 and 2012, a truly devastating human cost. Governments injected massive sums, like the Troubled Asset Relief Program, allocating $700 billion to stabilize failing institutions. Central banks reduced interest rates almost to zero and purchased trillions of dollars in assets through quantitative easing measures. The gross domestic product of the United States contracted by 4.3% from its pre-crisis peak to its low point in 2009, representing the worst economic slump since the 1930s. Trust in the financial system fell to historic lows among the populace, a difficult gap to bridge. Policymakers introduced sweeping reforms like the Dodd-Frank Wall Street Reform and Consumer Protection Act. In 2010, a law with thousands of pages aiming to prevent future systemic meltdowns. This legislation enforced stricter capital requirements for banks, demanded greater transparency in derivatives markets, and established new agencies like the Consumer Financial Protection Bureau, protecting millions. Despite these significant interventions, economic recovery was slow and uneven, taking many years for employment levels to return to pre-crisis numbers. Wage growth remained stagnant for many middle-income families for nearly a decade afterward. Global trade volumes saw a sharp decline by almost 12% in 2009, a widespread ripple effect affecting businesses. European nations subsequently faced their own sovereign debt crisis, partly fueled by the global downturn, with countries like Greece requiring multiple bailouts amounting to hundreds of billions of euros. The long-term psychological impact on an entire generation included increased financial conservatism among younger adults and a deepened skepticism toward large corporations. Many small businesses struggled to access credit for extended periods, hindering growth, causing further job losses. The federal debt expanded by trillions to fund the bailouts and stimulus packages, pushing the national debt past $14 trillion. By 2011, a staggering fiscal burden. The stock market lost over 50% of its value from its peak in 2007 to its trough in 2009, erasing trillions more in investor wealth, affecting retirement funds. Retirement accounts for millions of elderly people were severely diminished, forcing many to delay retirement plans by 5 to 10 years, a bitter reality. This massive economic dislocation fundamentally altered regulatory landscapes worldwide and profoundly reshaped public expectations of governmental oversight in financial markets, forever changing global finance operations.